There's a lot of confusion about how banks work and where money comes from. Very few of us really understand it. Economics graduates have a somewhat better idea than most of us, but many university economics courses still teach a model of banking that was never quite accurate. While it's bad enough that most of the public doesn't know where money comes from, what's especially concerning is that even many policymakers and economists still believe this inaccurate model taught in most economics departments is correct. In these videos, we'll go over how banks really work and how money is created. But first, to clear up any confusion, we need to go over what's wrong about the way that most people think banks work. Public perception of banking number 1. The safe deposit box. Many of us had a piggy bank when we were kids. The idea is really simple. Keep putting small amounts of money into your piggy bank, and when a rainy day comes along, the money will still be there waiting for you. For a lot of people, this idea of keeping your money safe sticks with them into adult life. Many people still believe that this is how banks work. When told that actually, banks don't just keep your money safe waiting for you to come back and get it, they'll often be surprised and feel like the bank has tricked them. So this idea that the banks keep our money safe is a bit of an illusion. Your bank account isn't a safe deposit box. The bank doesn't take your money, carry it down to the vault, and put it in a box with your name written on the front. And it doesn't store it in any digital equivalent of a safe deposit box either. What actually happens is when you put cash into a bank, that cash becomes the property of the bank. That's right. The cash that you deposit with the bank isn't even yours anymore once you deposit it. Because it becomes their property, the bank can use it for effectively anything it likes. But what are those numbers that appear in your account? Is that not money? In a legal sense, no. Those numbers in your account are just a record that the bank needs to repay you that amount at some point in the future. In the accounting of the bank, this is recorded as a liability of the bank to you, the customer. It's a liability because it's something the bank owes you. This concept of a liability is actually very simple and very important if you want to understand banking. Just think of it like this. If you borrowed $50 from a friend, you might make a note to remind you to repay the $50 in the near future. In the language of accounting, this is your liability to your friend. So, the balance of your bank account doesn't actually represent money that the bank is holding on your behalf. It just shows that they have a legal obligation, or liability, to repay you that amount at some point in the future. Whether they will actually be able to pay you when you ask for it is a different issue. But we'll talk about that later. Public perception of banking number 2. The middleman. A more common understanding of how banks work, which is somewhat more accurate, is that banks take money from savers and lend it to borrowers. This idea of banks as middlemen between people with spare money and people who need to borrow money is very common. In this model, banks borrow money from people who want to save it, such as pensioners and wealthy individuals, and then they use that money to lend it to people who need to borrow, such as young families that want to buy houses or small businesses that want to invest and grow. The banks in this model make their money by charging the borrowers a little more than they pay to the savers. The difference between the interest rates is how they profit. In this model, banks just provide a service by getting money from people who don't need it at the time to people who do. This implies that if there's no one who wants to save, then no one will be able to borrow. After all, if banks just lend out savings, then they need customers to deposit their savings before they can make loans. So, if nobody comes to the bank with savings, then the bank wouldn't be able to make any loans. It also implies that if the banks make enough loans, then eventually they'll run out of money to lend and have to stop lending until more savings come in. This model suggests it's good for the economy if we save, because it'll provide more money for businesses to grow, which will lead to more jobs and a healthier economy. This is the way that a lot of economists still think. In fact, a lot of economics courses at universities still teach that the amount of investment in the economy depends on how much we put aside in savings. But this is completely wrong, as we'll see shortly. Let me point out that, so far, we haven't talked at all about where money really comes from. Most people just assume that money comes from the government or the Federal Reserve. After all, that's what's written on the bills in your wallet. But as we'll see, this is mistaken. Our Money is campaigning to change the way money is created, and we need you to get involved. Share this video, join our campaign at ourmoneyus.org/signup to stay informed of our campaign efforts, and follow us on Facebook, Instagram, and Twitter at OurMoneyUS.